Legal disclaimer. The following content is intended strictly for educational and entertainment purposes only. This video involves discussions regarding foreign exchange trading, financial markets, and economic theories. None of the information presented herein constitutes financial, investment, legal, or tax advice. Foreign exchange trading, commonly known as Forex, carries a high level of risk and may not be suitable for all investors. The high degree of leverage available in Forex trading can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. There is a possibility that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and seek advice from an independent financial advisor if you have any doubts. Past performance is not indicative of future results. The creators of this content assume no responsibility or liability for any errors or omissions in the content of this video, or for any financial losses or damages you may incur acting upon such information. Proceed with caution and conduct your own due diligence. 90% of retail traders lose 90% of their capital within their first 90 days of trading. Let that sink in for a moment. It is known in the industry as the 90-90-90 rule, and it is the single most terrifying statistic in the financial world. If you walked into a surgeon's office and they told you that 90% of the people who undergo this specific procedure do not make it, you would run out of that building without looking back. Yet, every single day, thousands of ambitious, intelligent, and hopeful Americans open a brokerage account, deposit their hard-earned savings, and step into the arena of the foreign exchange market, completely unaware that they are walking into a statistical slaughterhouse. They enter the market believing they are the exception. They enter believing that because they watched a few videos on chart patterns or bought a signal service, they are ready to compete against the algorithms of Goldman Sachs, the currency desks at JP Morgan, and the central banks of the world. The reality is that the Forex market is the largest, most liquid, and most ruthless financial battlefield on Earth, turning over more than $6 trillion every single day. It does not care about your tuition payments, your rent, or your dreams of financial freedom. It is a zero-sum environment where for you to win, someone else, often someone with significantly more resources, faster technology, and better information than you, usually has to lose. Or more accurately, for the institutional giants to profit, the retail herd, which includes you, must provide the liquidity. Most beginners fail not because they lack intelligence, but because they lack the foundational understanding of the game they are playing. They are trying to play chess against a grandmaster, while barely understanding how the knight moves. The industry is flooded with marketing that sells you a dream of easy money, laptop lifestyles, and automated profits. You have likely seen the ads. A 20-year-old in a rented supercar claiming that trade-in G from a beach in Bali takes 15 minutes a day. This is the great illusion of the retail trading industry, a multi-billion-dollar marketing machine designed to churn and burn new traders for their commissions and spreads. They sell you the upside without ever educating you on the catastrophic downside. They show you the winning trade but hide the 10 consecutive losses that wiped out the account. This video is not part of that machine. This video is the antidote. Today, we are stripping away the marketing veneer and diving deep into the mechanics of survival. We are not here to sell you a course or promise you that you will quit your job next week. We are here to have the conversation that nobody else wants to have because it is not sexy and it does not sell subscriptions. We are going to break down exactly what you are up against and, more importantly, how you can flip the odds in your favor by focusing on the 5 critical pillars that separate the profitable 1% from the 90% who wash out. This is not about buying a specific currency pair or predicting where the euro is going tomorrow. This is about rewiring your brain to understand probability, risk management, and institutional behavior. If you are tired of blowing up accounts, if you are tired of the anxiety that comes with every open position, and if you are ready to treat this profession with the respect and seriousness it demands, then you are in the right place. This is a masterclass deep dive. We are going to explore the structural disadvantages of the retail trader and how to mitigate them. We will analyze why human psychology is naturally wired to lose money in financial markets, specifically how the fight-or-flight response destroys logical decision-making when money is on the line. We will look at the mathematical reality of leverage, explaining why it is the primary reason beginners go broke, not because the market moved against them but because they were overexposed. We will dissect the concept of market liquidity and how institutional algorithms hunt for your stop losses, not out of malice, but out of necessity to fill their massive orders. The promise of this series is simple but profound: clarity. By the end of this deep dive, you will no longer look at a price chart as a random squiggly line. You will see it as a visual representation of human emotion and institutional supply and demand. You will understand that trading is not about predicting the future. It is about managing risk in the present. You will learn that the goal of a beginner is not to make $1 million. The goal of a beginner is to survive long enough to learn how to make money. Survival is the skill. Capital preservation is the mandate. Everything else is secondary. We are going to dismantle the myths that have been fed to you by social media influencers. Myth number 1, that you need a high win rate to be profitable. We will show you mathematical proof that you can lose more trades than you win, and still make a fortune if your risk-to-reward ratio is managed correctly. Myth number 2, that technical analysis is a crystal ball. We will explain why indicators are lagging, and how price action tells the true story of the market. Myth number 3, that you need a massive account to start. We will discuss the power of compounding and why starting small is the only logical path to longevity. This masterclass is designed to be the resource I wish I had when I first started. It would have saved me tens of thousands of dollars and years of frustration. We are going to go slow. We are going to be thorough. We are not skimming the surface. Every point we discuss will be backed by the logic of market mechanics. We are building your foundation from the bedrock up, ensuring that when you do place that first live trade or your next trade, you are doing so not as a gambler hoping for a lucky spin, but as a risk manager executing a business plan. The journey of a Forex trader is usually broken down into 3 stages. The unconscious incompetent, where you don't know what you don't know; the conscious incompetent, where you realize how much you don't know and it becomes painful; and the conscious competent, where you begin to make money through sheer discipline and effort. Eventually, you aim for the final stage, the unconscious competent, where proper trading becomes second nature, like driving a car. Most of you watching this are likely in the first or second stage. This series is the bridge to the third. Prepare yourself to unlearn almost everything you think you know about making money. In the normal world, if you work harder, you get paid more. In trading, working harder often leads to overtrading and losing money. In the normal world, being right is rewarded. In trading, needing to be right is a fast track to bankruptcy because you will refuse to cut a losing trade. The rules of the market are counterintuitive to the rules of life. This is why it is so difficult. This is why the failure rate is so high. But it is also why the rewards for the few who master it are so significant. So, close the other tabs on your browser. Put your phone on silent. Grab a notebook and a pen, because the information we are about to cover is dense, nuanced, and critical for your financial survival. We are about to walk through the fire of market reality. If you are looking for a shortcut, click away now. If you are looking for the truth, stay with me. Let's begin with the first absolute necessity you must understand before you ever look at a chart. The first absolute necessity is understanding the specific nature of the beast you are trying to tame. We call this the zero-sum reality of the currency markets. You must internalize the fact that Forex is fundamentally different from the stock market. When you buy a stock like Apple or Microsoft, you are purchasing a piece of a company that creates products, generates revenue, and pays dividends. In a bull market, everyone can win. If the company grows, the stock price goes up, and every shareholder, from the billionaire hedge fund manager to the college student with one share, profits together. Wealth is created through economic expansion. Forex is not like that. The foreign exchange market is a zero-sum game, and when you factor in the broker commissions and spreads, it is actually a negative-sum game. Trading currencies is not investing. It is pure speculation on the exchange rate between two economies. Currencies always trade in pairs. For you to buy the euro, you must simultaneously sell the US dollar. For you to go long on the British pound, you are effectively shorting the Japanese yen. There is no scenario where everyone holds hands and makes money together. For every single profitable trade you close, someone on the other side of that transaction took a loss. Now imagine a high-stakes poker table. At this table, you have players with varying levels of skill and resources. If you look around the table and you cannot identify the sucker is you. In the Forex market, the players sitting across from you are not other retail traders in their pajamas. You are not competing against Dave from accounting who trades on his lunch break. You are competing against the smart money. This term refers to the institutional giants. The central banks, the commercial banks, the hedge funds, and the high-frequency trading algorithms. Let's break down this hierarchy because understanding your place in the food chain is vital for survival. At the very top, you have the central banks, the Federal Reserve, the European Central Bank, the Bank of Japan. They are not trading for profit. They are trading to control national economies. They have an infinite supply of money because they are the ones who print it. They can intervene in the market and move price thousands of pips in seconds to stabilize their currency. Trying to trade against a central bank intervention is like trying to stop a freight train with a piece of paper. Below them are the Tier 1 banks: JP Morgan, Deutsche Bank, Citi, UBS. These banks facilitate the vast majority of the daily trading volume. They have exclusive information. They see the order flow. They know exactly where the buy orders are stacked and exactly where the sell orders are clustered. They have proprietary trading desk staffed by math PhDs and economists who have access to news feeds and data terminals that cost more per month than most retail traders earn in a year. Then, at the bottom of the ocean, feeding on the scraps, is the retail trader. That is you. You have the slowest internet connection, the highest transaction costs, the least amount of information, and the least amount of capital. You are the plankton in an ocean of sharks. This might sound discouraging, and it should be. It should scare you into taking this seriously. The smart money views retail traders as liquidity. When a large institution needs to sell a massive position, they need buyers. Who do you think they sell to? They sell to the herd of retail traders who are blindly buying because they saw a bullish engulfing candle on a 5-minute chart. The institutions use your predictability against you. To illustrate exactly how ruthless this environment can be, let's look at a historical case study that devastated the retail trading community. Let's go back to January 15, 2015. This day is known in the industry as Black Thursday. For 3 years prior, the Swiss National Bank had maintained a peg on the Euro-Swiss franc pair. They promised the world that they would not let the exchange rate drop below 1.20. They printed unlimited amounts of francs to buy euros to keep this floor in place. Retail traders looked at this and saw free money. They believed the central bank's promise. Thousands of traders went long on euro to Swiss franc at 1.20, putting their stop losses just below, thinking it was a risk-free trade. People leveraged their houses, their life savings, believing that the floor was unbreakable. Then, without a single warning, at 9:30 a.m., the Swiss National Bank announced they were abandoning the peg. In the blink of an eye, literally within seconds, the price didn't just drop, it crashed. But here is the terrifying part. Liquidity evaporated. Because everyone wanted to sell and nobody wanted to buy, the price gapped. Imagine you had a stop loss set at 1.19. You thought, the worst case scenario is I lose 1%. But because there were no buyers at 1.19, your order wasn't filled. The next available price was way down at 0.85. The market fell over 30% in minutes. Traders didn't just lose their account balances. They went into negative equity. Imagine logging into your account expecting to see a small loss, and instead seeing that your balance is zero, and you owe the broker $50,000. This happened to teachers, engineers, and students all over the world. Brokers went bankrupt that day because their clients couldn't pay back the negative balances. This event proved one thing. In the market, there are no guarantees, and the big players can change the rules whenever they want. The Swiss National Bank did what was best for the Swiss economy, and they did not care about the retail traders who got crushed in the process. This leads us to the second layer of the game you need to understand: the conflict of interest with your broker. Not all brokers are created equal. Many beginner-friendly brokers operate what is called a dealing desk, or B-book model. In this model, the broker does not send your trade to the real market. Instead, they take the other side of your trade. If you buy, they sell. If you win, the broker loses money. If you lose, the broker keeps your deposit. Think about that incentive structure. You are trading on a platform provided by an entity that profits directly from your failure. They might legally hunt your stop losses by slightly widening the spreads during news events, just enough to tag your stop order and kick you out of the trade before the price moves in your direction. While not all brokers do this maliciously, the structural conflict exists. You need to understand that in many cases you are betting against the house, and the house controls the software. So before you draw a trend line, you must accept that you are entering an adversarial arena. You are not investing in the euro. You are engaging in financial combat against entities with superior weaponry. The only way to survive is to be nimble, to stay under the radar, and to never ever expose yourself to a risk that can wipe you out. You cannot overpower the market. You can only surf the waves created by the whales without getting swallowed. Understanding the players is step one. But knowing who the enemy is doesn't help if you don't know the weapon that kills most traders. It's a tool that brokers dangle in front of you like a carrot, promising massive returns on small deposits. It is the primary reason why that 90% failure rate exists. It is called leverage. Most beginners think leverage is a tool for getting rich. They think, I have $500, but with 1:500 leverage, I can trade like I have $250,000. They see the upside potential. What they don't see, and what we are going to surgically dissect next, is the mathematical certainty of ruin that high leverage creates. You might think you understand leverage, but unless you understand the concept of risk of ruin and the psychological impact of leveraged losses, you are walking around with a loaded grenade with the pin pulled. So how does leverage actually turn a winning strategy into a losing one? How can being right about the direction of the market still result in a margin call? The answer lies in a mathematical trap that catches almost everyone, and we are going to break it down in the next section. The mathematical trap is straightforward, yet it is invisible to the untrained eye. It stems from a fundamental misunderstanding of what leverage actually is. Beginners view leverage as a power-up, a tool that amplifies their buying power. They see a broker offering 1:500 leverage and think, great, my $100 can control $50,000 of currency. I can make a fortune. But you must reframe this immediately. Leverage is not power. Leverage is a loan, and it is a loan that is collateralized by your account balance. When you use 1:100 leverage, you are borrowing 99% of the trade value from your broker. The broker is happy to lend this to you because they are risk-free. They hold your cash as a security deposit. The moment the trade goes against you and threatens to eat into the money they lent you, they will liquidate your position instantly. This is the margin call. Let's play out a scenario to make this visceral. Imagine you have saved up $2,000. This is money you worked hard for. You deposit it into a trading account. You feel confident. You see the euro moving up against the dollar, and you decide to enter a standard lot trade. In Forex terms, a standard lot is 100,000 units of currency. To control 100,000 euros, you would normally need roughly $110,000. You don't have that. But with 1:100 leverage, your broker allows you to open this position by putting up roughly $1,100 of your own money as margin. You take the trade. You have used more than half of your account balance just to open the position. Now you are controlling $100,000 worth of currency. Here is the math that kills. If the euro drops by just 1%, a tiny fluctuation that happens on almost any given Tuesday, the value of that $100,000 position drops by $1,000. Since you only have $2,000 in your account, and you have lost $1,000 on the trade, you have just lost 50% of your entire net worth in a single market move. If the market drops just 2%, you lose $2,000. Your account is zero. The broker's software will automatically close your trade the millisecond your equity hits zero, or slightly before, depending on the stop-out level, to ensure they don't lose their money. You are wiped out. A 2% move against you is all it took. Now, compare this to investing in stocks without leverage. If you bought $2,000 worth of Apple stock and it dropped 2%, you would be down $40. It is annoying, but it is not fatal. You can wait for it to recover. In the leveraged Forex market, you do not have the luxury of time. Leverage compresses time. It speeds up the rate at which you realize results. It turns a small ripple in the market into a tsunami for your bank account. This brings us to the concept of drawdown and the death spiral of recovery. This is the piece of data that usually makes the room go silent when I present it. The math of losses is not linear. It is geometric. If you lose 10% of your account, you need to make an 11% gain on the remaining balance to get back to break-even. That doesn't sound too bad. But let's say you are aggressive. You take that big trade we just talked about and you lose 50% of your account. You started with $2,000 and now you have $1,000. To get back to your original $2,000, you now have to double your money. You need a 100% return on investment just to break even. Do you know how hard it is to generate a 100% return? The best hedge fund managers in the world, the titans of Wall Street, struggle to make 20% a year. You now need to make 100% just to get back to zero. Shutterstock. Explore. Gets worse. If you lose 90% of your account, leaving you with $200 out of your original $2,000, you now need a 900% return just to break even. It is effectively impossible without taking insane risks that will likely lose you the last $200. This is why capital preservation is the holy grail. Once you dig yourself into a deep hole, the math prohibits you from climbing out. The deeper the hole, the steeper the ladder becomes, until the ladder is vertical and unclimbable. Case studies of failed traders almost always show the same pattern. They start with a few wins. This is actually the worst thing that can happen to a beginner. They enter a high leverage trade, get lucky, and double their account in a day. Their brain floods with dopamine. They think they have cracked the code. They think, if I can make $2,000 in a day, I can make $10,000 next week. They attribute their success to skill when in reality it was variance. They were driving a car at 200 miles per hour blindfolded and just happened not to hit a wall. Then they increase their leverage. They engage in what we call revenge trading. After a loss, they feel an emotional need to get the money back immediately. They assume the market owes them, so they double the position size. I'll make it back in one trade, they tell themselves. This is the gambler's fallacy. The market has no memory. It does not know you lost the last trade and it does not care. When you increase leverage to recoup losses, you are merely accelerating the speed at which you hit the concrete wall. You must understand that professional traders, the ones managing millions of dollars, use very low leverage. Often they use effectively no leverage or perhaps 1:2 or 1:5. They are terrified of drawdown. They know that if they lose 50% of their clients' money, they are fired and their career is over. Conversely, the amateur trader with a $500 account is using 1:500 leverage, acting like a reckless cowboy. It is a paradox. Those with the most money take the least risk, and those with the least money take the most risk. And that is exactly why the money flows from the amateurs to the professionals. Consider the risk of ruin concept. This is a statistical probability calculation used by professional gamblers and traders. It calculates the likelihood that you will lose your entire bankroll based on your win rate, your payoff ratio, and the percentage of capital you risk per trade. If you risk 10% of your account per trade, which many beginners do, even with a decent strategy, your risk of ruin is near 100%. It is a statistical certainty that you will eventually hit a losing streak long enough to wipe you out. A streak of 5 losses in a row is common. If you risk 10% per trade, 5 losses puts you in a 50% drawdown, and we already know that means you are statistically dead. However, if you risk 1% per trade, you would need to lose 100 trades in a row to wipe out your account. Even a monkey hitting random buttons won't lose 100 times in a row. By reducing your risk, you buy yourself the most valuable asset a beginner can have: survival time. Time allows you to learn. Time allows you to make mistakes without catastrophic consequences. So, if leverage is the weapon that kills you, and risk is the variable you must control, how exactly do you determine how much to buy or sell? You can't just guess. You can't just say, I'll trade 0.1 lots. That is not a strategy, that is guessing. There is a precise, non-negotiable mathematical formula that you must perform before every single trade execution. It is the only way to ensure that no matter how much the market moves against you, you never lose more than a predetermined amount of money. Most people ignore this step because it involves a tiny bit of math and they are lazy. They want to click buy and watch the green numbers. But this single calculation is the firewall between you and poverty. It is the secret weapon of the 1%. Without it, you are gambling. With it, you are managing a business. We are about to walk through the mechanics of position sizing, and I am going to give you the exact framework to calculate it in seconds. If you skip this next part, you might as well donate your trading capital to charity right now because the market will take it anyway. Let's look at the formula that saves careers. The formula that separates the professional from the gambler is known as the position sizing algorithm. It is not complex calculus, but it is the absolute bedrock of risk management. Before you ever click the buy or sell button, you must perform this calculation. If you do not, you are not trading. You are playing roulette with your financial future. The formula is position size lots equals stop loss distance in pips times pip value, account balance times risk percentage. Let's break this down variable by variable because if you get one of these wrong, the output is financial suicide. First, your account balance. This is the easy part. It is the cash you have available to trade. Second, the risk percentage. This is the number we discussed in the previous section. For a beginner, this number is non-negotiable. It is 1%. Not 2%, not 5%, and certainly not whatever I feel like today. It is 1%. This means on a $10,000 account, you are willing to lose exactly $100 on a trade. No more. Third, the stop-loss distance in pips. This is where most beginners fail. They decide they want to trade a specific lot size, say one standard lot, and then they adjust their stop-loss to fit that lot size. They place the stop loss 10 pips away because that's all they can afford to lose with that lot size. This is backward. The market does not care about your wallet. The market structure dictates where your stop loss goes. If the technical analysis says the invalidation point for the trade is 50 pips away, then your stop loss must be 50 pips away. If you place it closer just to trade a bigger size, the market noise will hit your stop, kick you out, and then proceed to go in your direction. You must determine the stop loss distance based on the chart, not your greed. Fourth, the pip value. This varies depending on the currency pair and your account currency. For Euro to US dollar on a standard account, 1 pip is worth $10 per standard lot. For other pairs like pound sterling to Japanese yen or Canadian dollar to Swiss franc, this value changes slightly. You must know this value. Now let's plug this into a real-world step-by-step imagine-if scenario to see why this is magic. Imagine you have a $10,000 account. You spot a setup on Euro to US dollar. You determine that your entry is at 1.1000 and your stop loss needs to be at 1.0950. That is a 50 pip stop loss. You want to risk 1%, $100. You divide $100 by 50 pips multiplied by $10 per pip. The math is $100 divided by $500. The result is 0.2 lots. So, you enter the trade with 0.2 lots. If the price hits your stop loss, you lose exactly $100. Now, imagine the next day you see a different setup on the same pair, Euro to US dollar. But this time the market is very tight. The volatility is low. Your entry is 1.1000, but the technical structure says your stop loss only needs to be 10 pips away at 1.0990. You still want to risk the same 1%, $100. The math changes. You divide $100 by 10 pips multiplied by $10 per pip. The math is $100 divided by $100. The result is 1.0 lot. Look closely at what just happened. In the first trade, you traded 0.2 lots. In the second trade, you traded 1.0 lot, a position 5 times larger. Yet, the risk to your bank account was exactly the same, $100. This is the revelation. Your position size is dynamic. It breathes with the market. When the market is volatile and requires a wide stop loss, your position size naturally shrinks to protect you. When the market is tight and precise, allowing for a close stop loss, your position size expands to maximize the opportunity. This is how you survive. You are not betting the farm. You are betting a precise, calculated unit of risk. The amateur trader does the opposite. They suffer from what we call fixed lot syndrome. They decide, I am a one-lot trader. They trade one lot when the stop loss is 10 pips, risking $100. Then, they trade one lot when the stop loss is 100 pips, risking $1,000. They have no consistency in their risk profile. One bad trade wipes out 10 good trades. They are driving on a winding mountain road at a constant speed of 100 miles per hour. Eventually, they will fly off a cliff. The professional slows down on the curves, lowers lot size with wide stops, and speeds up on the straights, increases lot size with tight stops. Furthermore, strict position sizing is the only cure for trading anxiety. Why do traders stare at their screens, sweating, hearts pounding, unable to look away? It is because they are over-leveraged. They do not know how much they will lose if the trade goes wrong, or they know the amount is too high for them to handle emotionally. When you use the formula, you know the worst-case scenario before you even click the button. You have essentially signed a contract with yourself. I am willing to spend $100 to find out if this trade works. Once that money is committed, the fear vanishes. You can walk away. You can sleep. You have paid the entry fee, and the rest is up to the market probabilities. This leads us to a crucial psychological distinction: thinking in percentages versus thinking in dollars. If you think in dollars, you will cap your own growth. If you have a $10,000 account, risking $100 feels fine. But what happens if you are successful? Fast forward 5 years. Imagine you are managing a $1 million account. 1% of $1 million is $10,000. If you are still thinking in dollars, you will hesitate. You will think, I can't risk $10,000 on a single trade. That's a used car. That's 3 months of rent. This fear will cause you to trade too small, and you will fail to utilize the power of your capital. But if you trained your brain to think in percentages, you realize that 1% is just 1%. The math is the same whether the account is $500 or $500 million. The zero on the end of the balance is irrelevant to the execution of the strategy. By strictly adhering to this formula, You remove the emotional attachment to the money. The chips on the screen are just units of a game, not your grocery money. This detachment is essential for clear decision-making. If you are worried about the money, you will exit winning trades too early because you want to lock in the profit to pay a bill. You will hold losing trades too long hoping they turn around so you don't have to realize the loss. This is how you lose. But risk management is only the shield. A shield keeps you alive, but it does not win the war. You need a sword. You need a way to ensure that your winning trades not only cover your losing trades, but actually generate a surplus. This brings us to the most misunderstood concept in trading. Most people think you need to predict the future to make money. They think you need to be right 80% or 90% of the time to get rich. I am going to tell you a secret that sounds impossible. You can be wrong more times than you are right. You can lose the majority of your trades and still make a fortune. In fact, some of the most successful trend-following traders in history have win rates of less than 40%. They are wrong 6 times out of 10, yet they are billionaires. How is this mathematically possible? Seems to defy logic. If I lose more often than I win, shouldn't I go broke? In a normal game, yes. But trading allows you to alter the payouts. In a casino, the payout is fixed. In trading, the payout is theoretically infinite. The concept that unlocks this paradox is the risk-to-reward ratio, RRR. This is the third pillar of your education, and it is the engine of profitability. Without understanding RRR, you are destined to churn your account until the broker fees eat the rest. But when you combine the position sizing we just learned with high risk-to-reward ratios, you create a mathematical edge that makes it almost difficult to lose money over the long run. So, how do you set up a trade so that you can be wrong 60% of the time and still buy the Ferrari? Let's open the hood on the mechanics of asymmetric compounding. Asymmetric compounding is the financial equivalent of alchemy. It allows you to turn a losing track record into a profitable business. To understand this, we have to look at the relationship between your stop loss and your take profit. This relationship creates your risk-to-reward ratio. Let's imagine a standard scenario for a beginner. We will call him Trader A. Trader A is obsessed with being right. His ego is tied to the green checkmark on his trading history. He wants to feel like a winner every single time. So, he adopts a strategy where he grabs profits very quickly. He risks $50 to make $10. He thinks, it is easy for the market to move 10 points, so I will win often. And he is right. He wins 90% of the time. He feels like a genius. Let's look at his math over 10 trades. He wins 9 trades. 9 times $10 is $90 of profit. Then trade number 10 happens. The market moves against him. Because he risks $50 to make 10, his stop loss is wide. He loses that one trade. One loss equals minus $50. His net profit after 10 trades is $40. He did a lot of work, took a lot of risk, and barely made lunch money. But here is the kicker. If he has just 2 losses in 10 trades and 80% win rate, which is incredibly hard to maintain, he actually loses money. 2 losses cost him $100. 8 wins make him $80. He is down $20 despite being right 80% of the time. This is known as negative asymmetry. It is picking up pennies in front of a steamroller. Eventually, you get crushed. Now let's look at the professional. We will call her Trader B. Trader B does not care about being right. She cares about making money. She understands that she cannot predict the future, so she structures her trades defensively. She refuses to enter a trade unless the potential reward is at least 3 times the risk. This is a 1-to-3 risk-to-reward ratio. She risks $100 to make $300. Her strategy is aggressive, and because she aims for larger targets, she misses more often. Her win rate is only 40%. She loses the majority of the time. Most people would look at her track record and say she is a failure. But let's run the math over the same 10 trades. She loses 6 trades. 6 times $100 is minus $600. She wins 4 trades. 4 times $300 is plus $1,200. 1,200 minus 600 equals a net profit of $600. Compare them. Trader A, 90% win rate, $40 profit. Trader B, 40% win rate, $600 profit. Trader B made 15 times more money than Trader, even though she was wrong almost twice as often. This is the secret that institutions do not want you to figure out. You do not need a crystal ball. You need a calculator. When you combine this with the position sizing we discussed in the last section, you become mathematically invincible over the long term. provided you have the discipline to stick to the rules. But, and there is always a but, implementing this is psychologically excruciating. It goes against human nature. We are wired by evolution to value immediate safety and immediate rewards. When a trade goes into profit by $50, your brain screams at you, "Take it. Take the money now before it disappears." This is the scarcity mindset. If you listen to that voice, you close the trade early. You cut your winner short. You turn a potential 1:3 trade into a 1:1 trade. You have just destroyed your mathematical edge. Conversely, when a trade is losing, your brain says, "Don't close it yet. It might come back." If you close it, the loss is real. If you hold it, there is hope. So you move your stop loss. You let the loss run. You turn a 1:1 risk into a 5:1 disaster. The old adage on Wall Street is, amateurs go broke taking large losses and small profits. Professionals get rich taking small losses and large profits. It sounds simple, but executing it requires you to override millions of years of biological programming. You have to be willing to feel the pain of a winning trade turning into a loser. Imagine this scenario. You are in a trade. You risked $100 to make $300. The price moves in your favor. You are up $200. You are so close to your target. Then the market reverses. It drops all the way back down. It hits your stop loss. You lose $100. Most beginners will smash their keyboard. They will scream, "I was up $200. I should have taken it." The professional shrugs. Why? Because the professional knows that to catch the $300 winner, you must be willing to let the $200 unrealized gain evaporate. You cannot capture the big move if you are constantly banking the small move. It is the price of doing business. If you intervene and close early, you are invalidating the probability model you built. Therefore, before you start trading, you must institute a hard rule. We call it the golden ratio rule. You never, under any circumstances, enter a trade setup that offers less than a 1-to-2 risk-to-reward ratio. If your technical analysis tells you the stop loss needs to be 20 pips, but the next resistance level, your target, is only 20 pips away, you do not take the trade. You skip it. It does not matter how sure you are that it will go up. The math does not justify the risk. You are a casino owner, not a gambler. Casino owners do not take bets where the payout doesn't favor the house. This discipline acts as a filter. It forces you to only take the highest quality setups. Instead of trading 10 times a day, you might trade 3 times a week. But those 3 trades have the mathematical potential to grow your account exponentially, while the day trader scalping for pennies is slowly bleeding to death through commissions and spreads. Let's visualize your progress so far. You have learned that the market is a zero-sum war zone. You have accepted that leverage is a loan that can bankrupt you. You have mastered the position sizing formula to strictly limit your risk to 1%. And now you understand that by aiming for high risk-to-reward ratios, you can lose more often than you win and still generate wealth. You have built the vehicle. You have the engine, the brakes, and the safety systems. But you are sitting in the driveway. You have a fast car, but you have no idea where you are going. You need a map. You need to know when to buy and when to sell. You need to know how to read the chaotic movements of the charts and decipher the intentions of the smart money. Most beginners look at a chart and see random bars going up and down. They try to apply patterns they found on Google Images, like a head and shoulders or a double top, without understanding the context. They treat trading like coloring by numbers. Oh, lines crossed here, so I buy. This is retail logic, and it is exactly what the institutions feast on. To survive, you must learn to read the raw language of the market. You need to understand market structure. Market structure is the footprint of the heavy movers. It tells you who is in control, the buyers or the sellers. It tells you when a trend is healthy and when it is dying. It is the difference between swimming downstream with the current and trying to swim up a waterfall. However, there is a specific way institutions manipulate market structure to trap retail traders before the real move happens. They create what looks like a breakout to lure you in, only to reverse price and take your money before flying in the original direction. It's called a liquidity grab. And if you don't know how to spot it, you will be the victim of it every single time. So, how do you distinguish between a real market move and a trap? How do you identify the true higher highs and lower lows amidst the noise? We are about to open the charts and dissect the anatomy of price action. This is the skill that turns the theory into practice. Let's learn how to read the mind of the market. Market structure is the heartbeat of the financial organism. It is the only thing on the chart that is real. Indicators like the Relative Strength Index or MACD are merely derivatives of price. They are mathematical formulas applying a filter to what has already happened. They are the rearview mirror. Market structure is the windshield. To drive the car, you must look through the windshield. At its core, market structure tells you the narrative of the auction. Is the market accepting higher prices? Then we are in an uptrend. Is the market seeking lower prices to find buyers? Then we are in a downtrend. It sounds simple, but the nuance lies in identifying the swing points. Higher highs and higher lows for an uptrend, and lower lows and lower highs for a downtrend. Imagine a staircase. If you are walking up a staircase, you take a step up, impulse, and then you pause to regain your balance, retracement. As long as you do not fall below the previous step you stood on, you are still making progress upward. In trading, this is an uptrend. The market surges to create a higher high, then pulls back to create a higher low. A trend remains valid strictly as long as the previous higher low remains unbroken. This is your line in the sand. Conversely, in a downtrend, the market falls to a lower low, rallies briefly to a lower high, which must stay below the previous high, and then continues to drop. The moment a higher low is broken in an uptrend, the structure has shifted. The narrative has changed. The buyers have lost control and the sellers have taken the wheel. This event is often called a break of structure or a change of character. However, if it were this easy, everyone would be rich. You would just buy the higher low and sell the higher high. But the market is designed to deceive. This brings us to the most violent concept in technical analysis: the liquidity grab, often referred to as the stop hunt. Let's walk through a forensic analysis of a trap that happens every single day. Imagine the euro to US dollar pair has been moving up. It sets a clear resistance level at 1.1000. Retail textbooks tell you two things: either sell at resistance or buy if it breaks out. Millions of traders see this 1.1000 ceiling. Those who sold early place their stop losses just above it, say at 1.1005. Those who want to buy the breakout place there, buy stop entry orders at 1.1005, hoping to catch the momentum. So, sitting at 1.1005 is a massive cluster of orders. It is a pool of liquidity. To a bank that needs to fill a sell order worth $500 million, that price point is a magnet. They cannot sell $500 million at the current market price without pushing the price down against themselves before they are fully filled. They need a counterparty. They need buyers. Who are the buyers at 1.1005? The retail traders getting stopped out of their short positions, buying to cover, and the breakout traders entering long positions, buying to open. So what does the smart money do? They use their capital to briefly push the price up. They punch through 1.1000. The price hits 1.1005, maybe even 1.1010. The retail crowd cheers. Breakout. To the moon. The short sellers panic. I'm out. Liquidity is triggered. The bank instantly sells into this buying frenzy. They offload their massive position at the best possible price, absorbing all the retail orders. Once their orders are filled, the buying pressure evaporates. There is no one left to buy. The price collapses. It drops back below 1.1000, then 1.0950, then lower. The retail trader is left holding the bag, wondering why the breakout failed. It didn't fail. It functioned exactly as intended. It was a trap to facilitate institutional business. This phenomenon explains why you often feel like the market knows exactly where your stop loss is. It effectively does, because your stop loss is placed in the same obvious location as everyone else's. You are hiding in a crowd, but the predator is hunting the crowd. To avoid this, you must stop looking at the chart like a retail trader and start thinking like a liquidity provider. Do not buy when the price breaks a high. Wait, you need confirmation. You want to see the trap spring. You want to see the price break the high, grab the liquidity, and then aggressively reject back into the range. That rejection is your signal. It tells you the breakout was fake and the real move is likely in the opposite direction. This leads to the critical concept of fractal nature. The market is self-similar across different time frames. A trend on a 1-minute chart looks exactly like a trend on a monthly chart. However, the higher time frame always dominates. This is the law of the jungle. The daily chart is the parent. The 1-hour chart is the child. The 5-minute chart is the pet. You do not let the pet drive the car. A common beginner mistake is zooming into the 5-minute time frame, seeing a beautiful uptrend and buying. They feel great, but they fail to check the 4-hour chart, which shows the price is crashing into a massive resistance level. The 5-minute uptrend was just a tiny retracement in a much larger 4-hour downtrend. They get crushed because they were fighting the larger current. You must adopt a top-down analysis approach. Start with the daily chart. Ask yourself, is the big picture bullish or bearish? If the daily is bullish, you are only allowed to look for buy setups. You then drop down to the 4-hour chart to find the specific zones of interest. Finally, you use the 15-minute chart to time your entry. You are essentially using a telescope to find the land and a microscope to find the landing spot. If the time frames are not in alignment, if the daily is up but the hourly is down, you do nothing. You sit on your hands. Patience is a position. Let's look at a practical imagine-if scenario to solidify this entry protocol. Imagine the daily chart is in a clear uptrend. Price is making higher highs. Currently, the price is pulling back. It is dropping. Most beginners panic and sell, thinking the trend is over. You, the educated trader, know this is just a retracement. You are waiting for the price to hit a key structural level, a previous higher low. Price hits that level. Do you buy blindly? No. That is catching a falling knife. You zoom in to the 15-minute chart. You watch. The price dips slightly below the level, the liquidity grab, and then shoots back up with a strong green candle, breaking a local lower high on the 15-minute chart. This is a change of character on the lower time frame. It confirms that the buyers have stepped in at the higher time frame support. Now you have alignment. Daily is up. Hourly is at support. 15-minute has shifted bullish. This is the moment you strike. This is a high probability setup. You place your stop loss below the recent low, the trap, and target the next structural high. By combining market structure with liquidity concepts, you stop chasing price and start laying ambushes. You let the market come to you. You stop trying to predict every wiggle and start focusing on the major structural pivots. But even with perfect structure and perfect risk management, there is another invisible variable that can destroy your trade. It is a variable that most beginners completely ignore because they think the Forex market is a 24/7 convenience store. They think they can trade whenever they have free time. The reality is that the market is a ghost town for huge chunks of the day and a raging mosh pit for others. If you enter a trade during the dead zone, you will suffer from slippage, massive spreads, and erratic, choppy price action that bleeds your account slowly. There are specific windows of time, literally down to the hour, where the volume spikes, the real moves happen, and the probability of success triples. If you are trading outside of these specific kill zones, you are essentially trying to surf in a lake. You need the ocean's tide. So, when exactly should you be at your desk? What are the specific hours where the smart money punches the clock and moves the world? And why is trading during your lunch break likely the worst decision you could make? Let's synchronize our watches and uncover the secret of time and price. You must understand that the Forex market is not a continuous, flowing river of equal opportunity. It is a series of violent storms separated by long periods of devastating calm. The single biggest lie sold to beginners is the idea of financial freedom means trading whenever you want. They tell you that because the market is open 24 hours a day, 5 days a week, you can make money at 3 p.m. on a Tuesday or 11 p.m. on a Thursday. This is technically true, in the same way that it is technically true that you can find gold in your backyard if you dig deep enough. It is possible, but it is statistically highly unlikely and a waste of your resources. The market is composed of 3 distinct trading sessions, each with its own personality, its own volatility profile, and its own set of dangers. If you treat them all the same, you will lose. You are a hunter, and a hunter does not sit in the forest screaming at the top of his lungs at noon. The hunter waits for dawn or dusk, when the prey is moving. In Forex, we hunt volatility. Volatility is the fuel that moves price from point A to point B. Without volatility, you do not have a trade. You have a gamble that gets eaten alive by the spread. Let's break down the chronology of capital anchored to New York time, as that is the heartbeat of the global financial system. First, we have the Asian session, roughly 7 p.m. to 2 a.m. Eastern Standard Time. This includes Tokyo, Sydney, and Singapore. For the major pairs like Euro to US dollar or Pound Sterling to US dollar, this session is typically characterized by consolidation. The institutional volume is low. The central banks of Europe and America are closed. The price often moves sideways in a tight range, bouncing between a narrow support and resistance. We call this the Asian range or the Asian box. Beginners lose money here because they get bored. They stare at the screen desperate for action. They see a tiny candle move up and think, this is it, the breakout. They buy, but there is no momentum behind the move. The price reverses 5 minutes later, stops them out, and then goes nowhere. They get chopped up in the noise. The professional trader, however, looks at the Asian session not as a time to trade, but as a time to build a trap. They mark the high and the low of this session. They know that liquidity is building up above and below this box. Then comes the London session, starting with the Frankfurt Open around 2 a.m. Eastern Standard Time and the London Open at 3 a.m. Eastern Standard Time. This is when the giant wakes up. London is the financial capital of the world for Forex volume. When the London banks open their desks, liquidity floods the market. This is where we often see the Judas swing. Remember the liquidity grab we discussed? It happens most frequently right here. The price will often aggressively break out of the Asian range in one direction, let's say upward. Retail traders see this and jump in long, thinking the trend for the day has started. But this is a fake move. The London banks are pushing price up to trigger the stop losses of the early sellers and induce the breakout buyers, only to slam the price down and initiate the real trend of the day. The high or low of the day is very often formed during the London Open. If you are sleeping through this, or worse, waking up right after it happens, you are missing the clearest signal the market offers. Next, we have the New York session, specifically the New York Open at 8 a.m. Eastern Standard Time. This is the second injection of massive volatility. The U.S. banks come online. The U.S. stock market opens at 9:30 a.m. Economic news data, inflation reports, GDP numbers, non-farm payrolls, are released at 8:30 a.m. or 10 a.m. These events act as rocket fuel. But the magic moment, the absolute golden hour of trading, is the London-New York overlap. This occurs between 8 a.m. and 11 a.m. Eastern Standard Time roughly, until London closes around noon. During this window, the two largest financial centers in the world are open simultaneously. Volume is at its peak. Spreads are at their tightest. Moves are clean, decisive, and powerful. A setup that forms during the overlap has a statistically higher probability of success than a setup that forms at 5 p.m. because the sheer weight of money behind the move bulldozes any obstacles. Imagine you are trying to push a car. In the Asian session, you are pushing it uphill by yourself. In the overlap, you have 1,000 other people pushing with you. Why would you ever choose to push alone? Now let's talk about the dead zone. This is the period after the London close and before the Asian Open, roughly 5 p.m. Eastern Standard Time. This is the rollover period. This is the most dangerous time to have an open position. At 5 p.m. Eastern Standard Time, the banking day officially ends in New York. For a few minutes to an hour, liquidity completely evaporates. The major banks withdraw their orders to settle their accounts for the day. When liquidity vanishes, the spread, the difference between the buy and sell price, explodes. During the overlap, the spread on euro to US dollar might be 0.1 pips. At 5 p.m. Eastern Standard Time, that spread can widen to 10, 20, or even 50 pips instantly. If you have a tight stop loss, you will be stopped out simply because the spread widened, even if price didn't actually move against you on the chart. The broker simply cannot find a match for your order at the normal price. Trading during this time is financial suicide. Yet, many beginners who trade after work fall into this specific trap, wondering why they instantly start every trade with a massive loss. Let's run a case study to visualize the difference. Trader A lives in California. He gets home from work at 6 p.m. Pacific Time, 9 p.m. Eastern Standard Time. He opens his laptop. He looks at the pound sterling to US dollar chart. The market is in the Asian session. The candles are tiny. The price is wiggling back and forth within a 10-pip range. He gets frustrated. He forces a trade because he needs to make money today. He buys. The price sits there for 4 hours going nowhere. He goes to sleep. While he is asleep, the London Open happens at midnight his time. The volatility spikes. The price moves 50 pips against him. He wakes up to a blown account. Trader B lives in the same time zone. But Trader B understands time and price. He does not trade at night. He sets an alarm for 5 a.m. Pacific Time, 8 a.m. Eastern Standard Time. He wakes up right as the New York Open is starting. He sees that during the night, London has already set the high of the day, and the trend is down. He waits for a small retracement during the New York opening bell. He enters a short position. Because the volume is massive, the price drops immediately. Within 45 minutes, he has hit his target. He closes his laptop at 6 a.m. and goes to his day job or goes back to bed. Trader A worked for 6 hours and lost money. Trader B worked for 1 hour and made money. The difference was not skill. The difference was timing. You must align your schedule with the institutional flows. If you cannot trade during the London or New York sessions due to your job, you must look at swing trading on higher time frames, daily/4 hour, where intraday volatility matters less. But do not try to day trade the 5-minute chart during the Asian session expecting New York results. You cannot squeeze blood from a stone. This concept of kill zones, specific 2 to 3 hour windows where you hunt, allows you to minimize your screen time and maximize your focus. You should not be staring at charts for 8 hours. The human brain cannot maintain peak cognitive performance for that long. You will suffer from decision fatigue. You will start seeing patterns that aren't there. By restricting yourself to the kill zones, you preserve your mental capital. And mental capital is just as important as financial capital. This brings us to the most difficult hurdle of all. You can understand market structure perfectly. You can have the math of position sizing tattooed on your arm. You can be sitting at your desk at exactly 8:30 a.m. Eastern Standard Time with a cup of coffee, ready for the news. You can have the perfect plan, and you can still destroy everything in 5 seconds. There is a glitch in the human operating system. It is a biological override switch that activates when you are under stress or when you handle money. It shuts down the logical prefrontal cortex, the part of your brain that knows the rules, and hands control to the amygdala, the primal fear center of the brain. This is why smart people do stupid things in the market. This is why a doctor can be a terrible trader. The market is designed to exploit this biological flaw. It is called the psychology of the drawdown, and it is the final boss you must defeat. If you do not understand how your own brain chemistry is working against you, you will self-sabotage every single time you get close to success. You will move a stop loss when you promised you wouldn't. You will double down when you should walk away. Why do we do this? Why are we wired to fail at trading? Let's dissect the neuroscience of a losing trade. To your primitive brain, money is not just currency. Money represents resources. It represents food, shelter, and safety. It represents survival. Therefore, when you lose money, your brain does not interpret this as a mathematical adjustment in a spreadsheet. It interprets it as a threat to your existence. It perceives a red candle on a chart the same way it perceives a predator jumping out of the bushes. This triggers the amygdala hijack. The amygdala is the ancient part of your brain responsible for the fight or flight response. When it senses danger, in this case a drawdown, it floods your system with cortisol and adrenaline. Here is the critical part. When the amygdala activates, it effectively cuts the power cord to the prefrontal cortex. The prefrontal cortex is the part of the brain responsible for logic, planning, impulse control, and math. It is the part of the brain that knows your trading plan. So, literally, in the heat of a losing trade, you become physiologically incapable of rational thought. You are not stupid, you are chemically impaired. This leads to 2 distinct destructive behaviors: the fight response and the flight response. The fight response in trading is what we call revenge trading. Imagine you just took a loss. You followed the rules, but the market stopped you out. You feel a surge of anger. You feel like the market stole from you. Your heart rate spikes. You think, I am not going to let them take my money. You immediately open another trade, often in the opposite direction with double the lot size. You are trying to fight the market to get your money back. You have thrown your risk management out the window. You are now trading on pure aggression. The market, being an unemotional, infinite liquidity pool, will simply absorb your aggression and take the rest of your money. You are punching a concrete wall. The wall does not care, but your hand will break. The flight response is even more insidious. This manifests as the inability to pull the trigger or the refusal to accept reality. Imagine you are in a trade and it is going against you. It hits your mental stop-loss level. You know you should close it, but your brain screams, if I close this now, the pain becomes real. If I keep it open, there is a chance it comes back. You are running away from the realization of the loss. You freeze. You become a spectator in your own disaster. You watch the loss go from 1% to 5% to 20%, paralyzed by hope. Hope is not a strategy. Hope is the most dangerous emotion a trader can have. To make matters worse, human psychology suffers from a bias known as loss aversion, famously documented by psychologists Daniel Kahneman and Amos Tversky. Their research into prospect theory proved that the psychological pain of losing $1,000 is roughly twice as intense as the psychological pleasure of gaining $1,000. Losses hurt more than wins feel good. This asymmetry creates a fatal flaw in decision-making. Because the pain of losing is so intense, you will do anything to avoid it. This is why beginners hold on to losing trades for days, hoping for a reversal to avoid the pain of the loss. But they cut winning trades in minutes to secure the safety of the profit. They do the exact opposite of what the math requires. Remember the mantra: cut losses short, let winners run. The human brain is wired to cut winners short, let losses run. You are fighting your own biology. There is also the trap of random reinforcement. This is what makes gambling addicted. Sometimes you will do the wrong thing and get rewarded for it. You might move your stop loss, a cardinal sin, and the market might actually reverse and put you in profit. Your brain releases a massive hit of dopamine. You feel like a genius. You think, I knew it would come back. This is the worst possible outcome for a beginner. You have just been rewarded for bad behavior. Your brain has now encoded a new rule. Moving stop losses leads to pleasure. You will repeat this behavior. The next time the market will not turn around. It will keep going. And because you are conditioned to wait, you will lose everything. A winning trade taken with bad habits is infinitely more destructive than a losing trade taken with good habits. So, how do you override millions of years of evolution? You cannot simply will yourself to be unemotional. You cannot turn off the amygdala. You must build external systems that bypass your internal wiring. The first defense is the checklist protocol. Pilots use checklists because they know that in an emergency, their memory and logic might fail. You need a physical printed checklist on your desk. Before you enter a trade, you must physically check boxes. Is the daily trend aligned? Check. Is the risk-to-reward ratio 1 to 2 or better? Check. Is the position size calculated for 1% risk? Check. Is the release of high-impact news more than an hour away? Check. If you cannot check every box, you do not trade. This forces the prefrontal cortex to stay engaged. Slows you down. It prevents the impulsive click that comes from the emotional brain. The second defense is the walk-away rule. You must have a hard stop for your trading session. For example, if you take 2 consecutive losses, you are done for the day. Close the platform. Turn off the computer. Leave the room. Do not look at the charts on your phone. Why 2 losses? Because after 2 losses, your chemical state is compromised. You are likely entering the revenge trading mindset. You are no longer looking for good setups, you are looking for redemption. By mechanically forcing yourself to stop, you protect your capital from your own psychology. You live to fight another day. The market will be there tomorrow. Your money will only be there if you protect it today. Case studies of top hedge fund managers reveal that they are not emotionless robots. They feel the same fear and greed that you do. The difference is that they have masterfully engineered their environment to minimize the impact of those emotions. They have risk managers who tap them on the shoulder and say, "You're down for the day, take a break." As a retail trader, you are the CEO, the trader, and the risk manager. You have to tap yourself on the shoulder. This requires a level of self-awareness that most people never develop. You have to become an observer of your own thoughts. When you feel your heart racing, you must recognize it as a biological signal, not a market signal. You must say, "I am compromised. I am stepping away." If you can master this, if you can learn to lose without losing your mind, you have solved the puzzle that defeats 90% of traders. You have survived the math, the market structure, and your own biology. But now you are faced with a practical problem. You have all the theory. You know what to do and what not to do. But how do you actually practice this without going broke? You cannot learn to drive a Formula One car by reading a manual. But you also shouldn't jump into a race on your first day. You need a simulator. You need a proving ground where mistakes are free, but the lessons are real. Most people skip this step because they are impatient. They want to make real money now. They treat the simulator as a video game, or they skip it entirely. This is a catastrophic error. There is a specific step-by-step process to transition from a paper trader to a live trader that ensures you earn the right to risk capital. If you try to skip the line, the market will send you to the back of the queue with an empty wallet. So, what is this transition protocol? How do you prove statistically and undeniably that you are ready to trade real money? Let's look at the concept of the incubator phase. The incubator phase is the non-negotiable bridge between theory and reality. In the professional world, you do not get to fly a $70 million fighter jet just because you read the manual and passed the written exam. You spend hundreds of hours in a flight simulator. You crash safely in a virtual environment so that you do not die in a real one. The incubator phase is your flight simulator. It is where you prove to yourself, not your friends, not Instagram, but yourself, that you are actually capable of extracting profit from the market. However, there is a wrong way to use a simulator. Most beginners treat a demo account like a video game. They open a demo account with $100,000 of virtual play money. They take reckless trades with massive lot sizes because there are no consequences. If they lose $50,000, they just hit the reset button. If they make $50,000, they feel a false sense of confidence. They think, if this was real money, I would be rich. This is a delusion. It is actively harmful. When you trade with play money and no fear, you are not practicing trading. You are practicing gambling. You are training your brain to ignore risk. When you inevitably switch to a live account, the psychological pressure of losing real money will crush you because you never built the emotional callus to handle it. To use the incubator correctly, you must mirror reality. If you plan to deposit $2,000 of your own savings into a live account, you must contact your broker and have them set your demo account balance to exactly $2,000. You need to feel the constraints of a small account. You need to see how slowly it grows with proper risk management. You need to desensitize yourself to the boredom of disciplined growth. This phase consists of two distinct testing protocols: backtesting and forward testing. You cannot skip either. Backtesting is the process of scrolling back in time on your charts, going back to 2020, 2019, 2018, and replaying the price action bar by bar. You use the bar replay feature on your charting platform. You wait for your specific setup to form. You pause the simulation. You calculate your position size. You place the virtual trade. You let the candles play out. You record the result. You do not do this 10 times. You do this hundreds of times. You need a sample size that is statistically significant. We call this the 100 trade rule. You cannot claim to have a strategy until you have backtested it over at least 100 trades. Why? Because in a sample of 10 trades, luck dominates. You could win 8 in a row by pure chance. But over 100 trades, luck cancels out, and only the true edge remains. If you backtest 100 trades and you are profitable, you have something priceless: confidence. When you are in a losing streak in live trading, and you won't panic and change your strategy. You will look at your data and say, I have tested this over 5 years of data. I know this strategy works in the long run. This is just a statistical variance. That belief is the only thing that keeps you holding the line when things get tough. After backtesting comes forward testing. This is trading in a demo account in real time. This tests something backtesting cannot: your patience. In backtesting, you can fast forward through the boring parts. In forward testing, you have to wait. You have to sit on your hands for 3 days waiting for the setup. You have to deal with the urge to force a trade out of boredom. This is where you learn to act like a sniper, lying in the mud for days, waiting for the one perfect shot. During this entire process, you must maintain a trading journal. This is not a Dear Diary entry. This is a scientific log of your business operations. Most beginners rely on their broker's history tab. That is useless. It only tells you how much you made or lost. It does not tell you why. Your journal must track the why. For every trade you record, the date and time, the pair, the setup, e.g., break and retest of 4H resistance, the risk-to-reward ratio proposed, the result, win/loss, the emotional state, e.g., felt anxious, felt calm, revenge traded, a screenshot of the chart at the moment of entry and the moment of exit. This journal is your mirror. After 50 trades, you open your journal and look for patterns. You might discover, oh look, every time I trade the pound sterling to Japanese yen pair, I lose money. I should stop trading that pair. Or, every time I trade during the Asian session, I lose. I should stop trading at night. Or, every time I feel anxious entering a trade, it ends up being a loss because I was rushing. This data allows you to optimize yourself. You are not guessing what is wrong, you are diagnosing it with data. You are treating your trading like a professional athlete treats their performance analytics. Without a journal, you are blind. You are making the same mistakes over and over again, expecting a different result. So, when are you ready to go live? What is the graduation criteria? It is not a feeling. It is a metric. You are ready to go live only when you have achieved profitability in your demo account for 3 consecutive months. Not one great week. Not one lucky month. 3 months of consistent execution where your equity curve is slowly, steadily rising. This proves that you can handle different market conditions. Proves you have consistency. Once you pass this test, you initiate the soft launch. You do not deposit your entire savings. You deposit a test pilot amount, money that you are fully prepared to lose. Maybe it is $200. Maybe it is $500. The goal of this first live account is not to make money. I repeat, the goal is not to make money. The goal is to see if you can execute your plan when real emotions are involved. You will find that your heart beats faster. Your palms sweat. You hesitate. This is normal. You are acclimating to the pressure. If you lose this small account, it is a tuition fee. It is the cost of education. It is infinitely better to blow a $200 account learning these lessons than to blow a $20,000 account. You earn the right to scale up. If you can keep the $200 account alive and profitable for another 3 months, then you add more capital. You earn your deposits. You do not dump money into the market. You feed the account as it proves its health. This systematic approach, backtesting to verify the edge, forward testing to build patience, journaling to optimize performance, and soft launching to manage emotional shock, is the path of the professional. It is slow. It is unglamorous. It is boring. And that is exactly why it works. The exciting path leads to a cliff. The boring path leads to the bank. Now we have covered the legalities, the market players, the trap of leverage, the math of position sizing, the magic of risk to reward, the structure of price, the importance of timing, the psychology of fear, and the protocol for practice. You have the map. You have the vehicle. You have the skills. But there is one final piece of the puzzle. It is the philosophy that will keep you in the game for decades. It is the difference between a trader who burns out in 2 years and a trader who builds generational wealth. It is about understanding the lifestyle of the trader versus the illusion of the influencer. It is about sustainability. It is about knowing what to expect in year 1, year 5, and year 10. It is about the long game. Most people quit right before the breakthrough because they have unrealistic expectations of the timeline. They think they are failing when they are actually just in the learning curve. We need to set the correct expectations for your career trajectory so that when the hard times come, and they will, you know exactly where you are on the map and why you must keep going. Let's conclude this masterclass by looking at the roadmap of your future, the realistic milestones of a professional trader, and the final mindset shift you need to adopt to become the top 1%. This is the long-term vision. The timeline of a professional trader is not measured in weeks or months. It is measured in years. If you come into this expecting to pay off your mortgage by Christmas, the market will humble you by Thanksgiving. You must treat this exactly like you would treat becoming a surgeon, an engineer, or a concert pianist. Let's map out the realistic trajectory of the successful retail trader. This is the arc that the 1% actually walked. Year 1 is the year of survival. Your only goal in year 1 is to not blow up your account. That is it. If you end your first year with the same amount of money you started with, you are statistically in the top 10% of all beginners. You will likely lose money. You should view this loss not as failure, but as tuition. You are paying the market to teach you. You are paying for the lessons on psychology, risk, and structure that we have discussed. If you lose $2,000 in year 1 but gain the skill set that will pay you for the next 30 years, that is the best investment return you will ever see. Year 2 is the year of the grind. This is often the hardest year. You know enough to be dangerous but not enough to be consistent. You will have break-even months. You will have small winning months followed by a bad week. You will feel like you are spinning your wheels. This is the valley of despair. This is where the hobbyists quit because the novelty has worn off and the Lamborghini hasn't arrived. But this is where the neuroplasticity is happening. Your brain is slowly pattern matching. You are beginning to see the setup before it happens. You are beginning to feel the rhythm of the sessions. Year 3 is usually the year of the breakthrough. This is where the click happens. You stop trying to force trades. You stop getting angry at losses. You start to trust your edge. You might not be making millions, but you are consistently pulling a monthly income. You have proven the concept. You have moved from the conscious competent to the beginnings of the unconscious competent. And then comes the phase that changes everything, the scaling phase. This is the secret that the industry hides. You do not need to have a lot of money to make a lot of money. You only need the skill. Once you have the skill verified by a track record, capital will find you. In the modern era, we have the proprietary firm model. Imagine this scenario. You have spent 3 years mastering your craft. You have a $2,000 account. You are making 5% a month. That is $100. It is barely enough to pay for a nice dinner. Feels pointless. But then, you take that same skill set and you apply to a prop firm. You pay a small fee to take a challenge. You prove you can trade by hitting a profit target without violating risk rules. Because you have mastered the skills we discussed in this series, you pass. The firm hands you a funded account with $100,000 of capital. They take the risk, you provide the skill. You keep 80 or 90% of the profits. Now, that same 5% return is not $100. It is $5,000. You are doing the exact same work. You are taking the exact same trades. You are looking at the exact same charts. But your income has increased by 5,000%. This is the power of leverage, not on your money but on your skill. This is how retail traders become professional fund managers from their bedrooms. This is the path. But to walk this path, you must embrace the boring. Real professional trading is incredibly boring. If you are feeling an adrenaline rush, you are gambling. If you are cheering at your screen, you are gambling. A professional trader is a data entry clerk. They wait for the setup. It appears. They execute the plan. They input the data. They close the computer. It is repetitive. It is monotonous. And it is lucrative. You have to fall in love with the boredom. You have to find joy in the discipline, not the result. You have to derive your satisfaction from following your rules perfectly, regardless of whether the trade won or lost. If you took a losing trade but you followed your plan perfectly, you should pat yourself on the back. If you took a winning trade but you broke your rules to get it, you should punish yourself, because you just reinforced a bad habit that will eventually destroy you. Ultimately, trading is the ultimate mirror. It reveals every flaw in your character. If you are impatient, the market will bleed you. If you are arrogant, the market will crush you. If you are greedy, the market will trap you. To become a master trader, you must become a master of yourself. You must develop stoicism. You must separate your self-worth from your net worth. This journey will demand more from you than any 9-to-5 job ever could. It requires you to take full responsibility for your life. When you lose, there is no boss to blame. There is no economy to blame. There is no colleague to blame. There is only you and the mirror. This extreme ownership is terrifying to most people, but it is liberating for the few who accept it. You now have the foundation. We have deconstructed the myth of easy money. We have exposed the institutional players. We have armed you with the math of survival and the psychology of endurance. You know about the liquidity traps, the kill zones, and the incubator phase. You are no longer part of the blind herd. You are awake. But knowledge without action is merely potential. The next step is yours. You can close this video and go back to watching cat videos or scrolling social media, allowing this information to fade into the background noise of your life. Or you can take the first step into the arena. You can open that demo account today. You can start your journal today. You can commit to the process of becoming the 1%. It will not be easy. It will likely be the hardest thing you ever do. But if you stick with it, if you survive the learning curve, if you respect the risk, the potential outcome is total autonomy. Not just financial freedom, but the freedom of time, of location, and of mind. This series was the what and the why. But we still have so much to cover regarding the how. How exactly do you draw the zones? How exactly do you identify the entry candle? How do you manage a trade when news breaks unexpectedly? I am not going to leave you here. We are going to build this together brick by brick. In the next video, we are going to leave the theory behind and go directly into the charts. I am going to show you a live step-by-step breakdown of a high-probability trading strategy that you can start backtesting immediately. We are going to look at real price action, identify the trap, and execute the entry. So, if you are ready to move from the classroom to the operating room, if you are ready to stop dreaming and start doing, then make sure you are subscribed and have the notification bell turned on. You do not want to miss what is coming next. You have the map. Now let's start the engine. I will see you in the next video.